This video is for the financial markets as part of the Year 13 specification for macroeconomics. It will specifically consider government intervention on ensuring a situation such as the financial crisis will be less likely to happen in the future. And the legislation that we're going to focus on is ring-fencing. During the financial crisis, there were issues related to how banks were operating and as to whether they were using everyday individuals' deposits on risky investments. Banks offer a range of products, and often the everyday person might not be aware of the investment side to a bank, only really recognising their commercial activities. So what ring fencing aims to do is separate the two. So, what is it? Ring fencing will require UK banks to separate their commercial activity from their investment banking. So this would therefore mean if UK banks made losses on their investment deals, it would not hurt the commercial side of the business, and therefore mean, for example, deposits won't be at risk. I suppose its aim is to reduce moral hazard, with the belief that some banks didn't really fear the risk during the 2009 financial crisis, as they thought they'd be bailed out by the government, and therefore ring fencing will prevent such reckless behaviour. Now, the difference between commercial banks and investment banks are the following. So your commercial banks handle your everyday activity, such as, for example, depositing accounts, providing debt account services, offering credits such as loans and overdrafts, allowing, just financial transactions, being, maybe sending money from one person to the next. Whilst investment banks offer more complex products, such as the underwriting of IPOs, so initial public offerings. So when businesses start to offer shares on the stock market, they'll be involved within that. Negotiate mergers and acquisitions between firms, and even the purchase and sale of bonds, and assisting with that as well for the private sector. Now I'm going to show you a video just to quickly highlight why ring fencing was seen to be needed.
The brief was simple: make the banks safe so the financial crisis of 3 years ago can't be repeated, and do it without damaging London as a financial hub. The solution will almost certainly be more complex. Sir John Vickers and his team are likely to suggest more competition on the high street, so at least one new big player to drive down costs for consumers, and they all should make it easier and quicker for people to switch current accounts. The Commission also wants big banks, in the event of a major mishap, to bail themselves out rather than asking taxpayers. But it's the ring-fencing suggestion which has attracted the most comment. The Commission says that big banks should partially separate their retail banking side from the riskier investment banking divisions. So if things go wrong on one side, the bit that handles savings and mortgages will be protected. But what does the public think?
There's always the assumption that you can put your money in the bank and it will be safe, and if that's been eroded, then it needs to be addressed, if only to reassure the public.
There's a lot of talk about banks are going to leave our shores if we do it, but I think it will blow over and they should do it.
You tend to think that banks are going to be very sensible with your money, and they haven't been. So it obviously does need to be regulation there.
The banking fraternity wasn't talking ahead of the publication of the report. Privately, they're saying that there's been quite a bit of change over the past 3 years, and any further ill-advised or hasty reform could damage not just their industry, but the entire UK economy. Joe Lynham, BBC News.
So, why is it needed? As mentioned before, a lot of banks require the government to provide financial emergency assistance during the financial crisis and bail them out. So accusations of moral hazard were heard, and due to systematic risk regarding how financially interconnected banks are, it was essential to try to protect banks from hurting its customers and other banks, as well as the whole financial market. So therefore, new regulation was made. Today, many banking groups provide a mix of services. The risk associated with these activities are very, very different, but often they are provided alongside each other within a banking group. So ring fencing will result in the separation of core banking services, taking deposits, making payments and providing overdrafts for UK retail customers and small businesses from other investment activities, as I mentioned before. So, as part of the response to the financial crisis, the government established the Independent Commission on Banking, the ICB, and that was led by Sir John Vickers. And it was the whole process was to recommend banking reform to promote financial stability and competition in the UK. So the ICB argued that if Lloyds and the Royal Bank of Scotland had been ring-fenced prior to the crisis, it may have reduced the need for government support during the crisis. So the PRA and the FCA created a legislation and ring-fencing requirements. And the ring-fencing requirements will apply to banks with more than £25 billion of retail deposits from 2019, so last year. So obviously it's focusing on the major banking groups. So as you can see, Barclays will ring fence 25% of their operations, Santander 30% and HSBC 9%. Now, obviously, ring fencing it was brought about from the financial crisis, but it's not just the financial crisis that kind of brought the idea of ring fencing. There was also examples of rogue traders, and rogue traders are those maybe working as just an individual strategy to try and profit as much as possible, and they will take ridiculous risks. You could probably argue illegal risks to do so. So I'm just going to show you a quick video from a news story which took place not so long ago.
Kweku Aduboli, a new entrant to the Bankers' Hall of Fame, or should that be Hall of Shame? The London-based trader of the giant US bank UBS is alleged to have racked up unauthorised losses of £1.3 billion. Hours after UBS uncovered the eye-watering loss, Mr Aduboli was arrested.
At 1 a.m. this morning, the City of London police were contacted by UBS about an allegation of fraud by one of their employees. And at 3:30 a.m, detectives from our force arrested the 31-year-old man on suspicion of fraud by abuse of position.
Here at UBS's sprawling network of offices in the heart of the City of London is where the alleged rogue trader worked. His colossal losses are likely to tip this giant bank back into loss for the latest 3-month period. But it's not the money, but the embarrassment that is likely to prove most painful, because this is a bank that after the great crash of 2008 claimed it was taking much, much less risk. UBS was among the banks worst hurt by the last banking crisis, incurring losses of more than £35 billion. Bailed out by the Swiss government, it changed its management and the way it does business. So what went wrong?
You can put in these technological systems that limit how much people can trade, but in the end, the problem is, if you're employing intelligent people and they want to get round these systems, there is a chance they will find a way. That is why what's needed is a moral compass from the top of the organisation, so people know what's right, know what's wrong, and they don't even think of doing these sort of things in the first place.
So if it turns out that Kweku Aduboli is a big-time rogue trader, how would his loss of £1.3 billion rank against other rogue traders? Well, the biggest loss ever, £4.3 billion, was racked up in 2008 by the French dealer Jérôme Kerviel at Société Générale. That's rather more than the £827 million loss of Britain's most famous rogue trader, Nick Leeson, who destroyed the venerable merchant bank Barings. After Kerviel was arrested in France, the British regulator, the Financial Services Authority, put pressure on banks to tighten up their scrutiny of traders. So, if that hasn't worked, what might?
Unless you separate out that Wild West casino operation from the world of banking inhabited by ordinary men and women in the high street and ordinary businesses, we're in real trouble. And that's what Sir John Vickers and his Banking Commission proposed earlier this week, and it's why we've got to get on with implementing that report as fast as possible.
This advert is how UBS likes to see itself, a virtuoso in the global world of banking. It's been humiliated by the alleged attempt to forge a solo career by one of its bankers. Robert Peston, BBC News.
So it's probably obvious to say that this move of ring fencing hasn't been popular within the financial markets, and many banks believe that ring fencing can restrict profitable investment decisions and therefore hurt UK's competitiveness. There's also belief that it might reduce revenue streams, which may mean higher costs for customers to make up for those restricted revenue streams. So more expensive borrowing, for example. And I suppose there was a lot of criticism from banks suggesting that historical examples of ring fencing, it might not have been called ring fencing, but very, very similar practice, has failed to work in the US in the 30s and the post-war Japan in the 1940s. And it was also to say that not all the banks that needed kind of help from the government and bailing out, not all of them had investment sides to their banking group. So for example, like Bradford and Bingley in the Co-op Bank, they needed help and they struggled, but they didn't have the investment side. So therefore, I suppose the financial crisis was caused by lots of different factors, and it might not just have been the investment type of banking that was taking place. Anyway, I'm going to show you just one final video based on some of the criticism of ring fencing.
Plans for UK banks is to ring fence retail operations, which is really your bag, from the investment bank, commonly called casino banking, isn't it? What's your view of that ring fencing plan?
Well, I think first of all, it's a reality. Government and the regulators seem convinced that it has to happen, and so we're acting as if it's going to happen. Personally, I think it's unnecessary, and I think it's potentially going to be quite damaging.
And why would it be damaging?
Well, what we've seen over the years is that there are natural links between different parts of banks. It's a continuum, and I think the desire to artificially separate all of those things is going, in the end, to raise costs. It's going to make banks less innovative, and it's actually going to lead, I think, to poorer service, particularly for corporate customers. You know, the focus on investment banking is always about this notion that these guys are sitting around just gambling, you know, a la casino banking. The reality is that most of what they're doing is laying off positions that are created by serving corporate customers who need to hedge their earnings in Europe or import commodities from Asia and so forth.
Now, that's a very important distinction, isn't it? So the investment bank does two things. It does stuff for clients, big corporations, for example, but they do things for themselves, don't they? They do expose themselves to positions, and they lend money to people, some of which is risky and some of which is less risky, and they trade in derivatives, which they may or may not understand, and they create securities which sit on the books. So the reason why we want the ring fence in this country has been specified as, my goodness, we don't want to bet the retail bank on the success or failure of a bunch of guys in the investment bank.
Yeah, the interesting thing, though, is that if you look at the banks that actually went down, the starting point was narrow retail banks. You know, Northern Rock is where it all started. A lot of this was based on quite banks that didn't have a lot of diversification in their businesses. And actually look around the world, it is most of the failures of banks have been narrow little banks. So this notion that just by having it narrow, it's going to be safe, I think personally, again, it's a personal view, I think it's misguided.